Sectors that we are most bullish on are the dry bulk and the liner space. Dry bulk is a sector that we've been bullish on since the sort of beginning of last year or middle of last year. And while stocks in that sector have run up a lot, we think there's still some upside potential, perhaps a little bit less than before. And that's principally because the fundamentals today look a lot better. The order book of dry bulk is about 7.5% of the current fleet, which is a 13-year low. On the demand side, you've got four principal drivers of demand. So you have iron ore, and you've got coal, you've got minor bulk, and you've got grain. And all of these different demand drivers are doing quite well. So iron ore is doing well because, driven again by China. There's a strong property market, infrastructure market, which is driving that. Although, of course, there's a risk that that may slow down. But even if that does, we don't expect it to slow down very much. And grain is growing very well. Globally, there's a strong demand from Asian countries, African countries, etc. Minor bulks are growing well. Thermal coal is something that we expect will do well in the short run. However, longer term, as countries are moving to renewable energy or cleaner energy, we expect there may be a slowdown. The other sector we're positive on is the liner sector. And so what's driving that is the consolidation in that space. Today you've got 7 players in the market who have more than 5% market share. So the market is what I would call moderately concentrated. Previously it was highly competitive. And in a moderately concentrated market, what you have is individual carriers are able to have the ability to an extent influence pricing. And so the volatility in pricing goes away. So at Drewry, we track container freight rates in 700 global routes. And we see evidence of this consolidation in play over here because we see the volatility of rates has gone down. Not everything can be explained by higher levels of utilization. So there's other factors at play, which, as I say, in our opinion, is probably the consolidation effect. The other positive for the container sector is the order book. It's not a huge positive because there is still quite a substantial number of ships that will be getting delivered in this year and next. I think it's about 14% of the total fleet. But having said that, it is still the lowest order book that we have seen in well over 10 years. Now, of course, liner companies, some of them have made some big orders, MSC, CMA, CGM. If this continues, then of course we could go back into an oversupply situation. But if it doesn't, then I think 2019 is going to be a fairly positive market in terms of demand-supply balance. Because the last 10 years we have seen too much supply, and that's been the biggest issue. So, but yeah, overall, I would say it is looking better than it was a few years ago, certainly. It's excellent. There's a very good mix of ship owners and capital providers, and it's very interesting to see how the alternative financiers are increasing their prominence, given that bank finance has become less available. And so it's a great group of people that you have over here.